Let's go, folks. Good morning. Welcome to the Street's opening bell here from Post 35 on the floor of the NYSE. That is, in fact, where we are. Today is Friday, January 6th. As you can see there, I'm JD Durkin. Opening bell rung moments ago here on the floor by professional bull riders in celebration of the sport's 30th anniversary. Stocks are trading up fractionally. I'm going to take a look in real time. They still up fractionally? Yeah, they are. Okay, NASDAQ up 0.5, S&P up 0.8. That's the story. This as investors digest the hotter than expected December jobs report, which showed that the U.S. economy added 223,000 jobs last month. A bit of revisions for the previous month. Maybe we'll get into that in just a bit. This coming above Wall Street's expectations for December of 200K, but we also got a bit of wage news that might be what investors more specifically are latching onto. All this furthering the Fed's claims that the job market is strong despite their efforts to cool it down. But again, wages are something that maybe a bit more important here in this. We'll dive into that in just a bit. Taking a look at what is on tap for this Friday morning show, we will talk the state of the labor market as strong jobs data tops analyst expectations, plus Tesla slashing EV prices in China yet again after deliveries slumped. And finally, we will tell you what is going on with Samsung as profit sinks to an 8-year low. For more on those stories and so much more on this Friday, we now welcome in our chief markets correspondent, Mr. Martin Baccardax. Okay, biggest news story of the morning, my friend. December jobs. The economy adding 223 last month compared to the street's expectations of 200K. Unemployment falling to 3.5, but I suspect it's wages that you might be most interested in. Maybe I'm wrong, but starting with the jobs number itself, what's your immediate reaction here, Martin?
Yeah, wages absolutely, JD, were the thing that leapt off the page. Essentially, the monthly gain in average hourly earnings was 0.3%. That was half the rate that we experienced over the month of November, and it was well below the analyst forecasts. On a year-to-year basis, wages are up 4.6%. Again, that was underneath the street forecast and well shy of the tally that we had over the month of November. So that's really important news. Now, again, we always have to look at the paradox between the actual employment market conditions and what the market, the stock market, is expecting, because, of course, all of those figures filter into expectations for inflation. If you are actually participating in the labor market, you're trying to get a raise or you're trying to change jobs, sliding or slowing wage growth is not necessarily great news. From the stock market perspective, it's relatively positive news simply because it lessens the concern for near-term inflation and perhaps changes the thinking of Federal Reserve policymakers when it comes to raising interest rates, not only next month, but going in to the teeth of the 2023 year. So that's probably why we had that burst of activity in stocks this morning and significant gains. They were pared slightly as people picked through the numbers, noticed some revisions in the month of November, and looked at the weakness perhaps in sort of private sector employment gains. But nonetheless, this was described as a Goldilocks jobs report, and I think that's largely correct. Goldilocks in the sense that it wasn't too hot in terms of in wage growth, but not too cold in terms of the ultimate jobs that were added to the economy. We've had 21 consecutive months of job gains for the U.S. economy, and over the last year, JD, we've added 4.5 million new jobs as a result of a whole host of policies and certainly the post-pandemic rebound. So the job market remains resilient. The excellent news underneath, at least from the market's perspective, is that wage growth isn't spiraling out of control. And that's, again, why we're seeing these gains in stocks this morning.
So to clarify for viewers who are watching, in terms of wages, I think you said up 0.3. So still increasing. It's just the pace is not as fast. So they're still going up. They still went up, just not as much as people were afraid they would. Again, keeping in mind that a lot of what we talk about sounds very counterintuitive.
No, you're absolutely right. And that's worth, I think, emphasizing, JD. We are looking at average hourly earnings gains that are 4.6% higher than the levels that we saw last year. That's good, but not great. It's not great when you compare it to the fact that headline inflation is about 7.1%. So really, workers aren't necessarily getting wage gains that would compensate for the price increases that they are experiencing in the real economy. And that has really been a component of the discussion in all of this. that has been largely ignored, and that's the fact that wages just aren't keeping up with inflation. So as a result, whilst we are overly critical in some cases of the Fed's efforts to tame inflation and the language it uses with respect to the labor market, we do have to remember that the Fed's task is actually a good one, in the sense that if it is able to hold inflation rates down and wages can maintain the level that we're seeing, suddenly workers will be getting paid more than price increases and will have a little bit of extra for discretionary spending. So it's worth it when you do hear these hypercritical sort of commentary that is parallel to a lot of the Fed decisions and how they want to kill the job market and put people out of work and how wage gains are bad news and all this stuff. It's worth ignoring that, because ultimately when you look at the broader task, and that's to ensure that workers are getting wage increases that are above levels of inflation, you see it as both a sort of a difficult task, but nonetheless one that comes from a good place.
Help me square the circle of recession commentary with 3.5% unemployment.
That's the difficult one, and particularly a 3.6% GDP growth rate over the fourth quarter as well. According to the latest figures from the GDP Now forecasting tool. All of those are very, very good. They probably, though, do reflect, JD, the puzzling picture that we are seeing in the labor market. We talked about the fact that redundancies, here I am using phrasing that doesn't necessarily apply to the United States. Layoffs are starting to increase. They're up about 130% compared to last year's levels. And we're seeing tech companies put people out of work at a really worrying pace. And of course, there's 10.45 million unfilled positions in the economy as of the end of November. So we don't really fully understand exactly how the labor market is playing out. And the unemployment rate also, JD, is only indicative of those people who are actively searching for work. When you look at numbers that include those people who have essentially given up the job search or have exited the market altogether, that number jumps into the low 6% range. So that might paint a more accurate picture of what we're seeing. But nonetheless, your larger point is absolutely correct. There's a lot of recession debate going on right now, and some of it is indicative of that sort of psychological aspect that we talked about yesterday in the concern of us talking ourselves into recession. But there was one data point, JD, that is worth pointing out, and that's the ISM non-manufacturing index this morning. Essentially what that does, it takes the pulse of activity in the services sector of the US economy, and that's the biggest and most important growth driver of all of them. That actually slipped into contraction over the month of December, and that's a really worrying signal because, again, it is just such a powerful component of US economic growth. That's only going to muddy that recession debate further. But what it will also do, JD, is indicate that wage gains aren't likely to accelerate much further because the prices that are being paid by the services sector companies are starting to fall as well. And as a result, they're not going to pass them on into price increases in the real economy, and there'll be less need for wage gains going forward as a result.
Do we have an updated read on CME projections for February? I know it's only been a year and a half. Maybe it has felt like a year and a half. It's only been an hour and a half. Yeah. Well, time doesn't make any sense these days, whether you're covering politics or business, to be fair.
True enough.
Do we have a sense on how this will do with considerations for our friends at the Fed come February?
Yeah, February 1st is when the interest rate decision will come. What we're seeing, at least this morning, JD, is an increase, but not significant, with respect to bets on a 50 basis point rate hike. We're currently at 4.25%. If we lift to 50, we'll take that up to 4.75 and closer to 5%. There's about a 40% chance of that. And that number has been increasing over the past week, certainly as a result of the hawkish Fed minutes, and just maybe tempered a little bit by the numbers that we've seen this morning. I'll want to watch this all play out through the remainder of the day and into the earnings season, because I think that will give us a truer picture of what we can expect in February. But I still think it's odds on for 50 basis points in February, and then we'll really get into the interesting tactics as to what the Fed is going to do, particularly if headline inflation rates begin to accelerate. We'll get numbers next week, and then, of course, into January. So there's a lot to play for. But at the moment, I think it's odds on for a 50 basis point hike in February.
Martin, I believe you said earlier on in our conversation we've had 21 consecutive months of positive job growth. Did I have that correct?
That's correct. Yep, that is correct.
At
4.5 million jobs
Yeah,
added over 2021. Yeah.
So at what point do we expect to see that number really start to slip down? If we were expecting 220, we got 223. Do we hit negative monthly payroll numbers? Is that in theory what the Fed would like to see? And if not negative, at least bring that 223 number a bit down closer to earth?
Yeah, I do think they want to see it decline, but certainly don't want to see it go negative. If we are going to engineer that soft landing that the Fed has said it can do, we are going to want to see moderating employment gains, slower wage growth, but not to the point where we tip into negative territory. That's a delicate balance, of course, but there is decent underlying strength in the economy, the ISM data from the month of December notwithstanding. And the momentum that the economy is carrying into 2023 may be solid enough for the economy to avoid that recession concern and give the soft landing that the Fed has been forecasting. But it will be an incredibly difficult task, and a lot is going to depend on the nature of corporate performance over the first 6 months of the year, which, as we spoke about earlier this week, puts the earnings season in stark focus, not only with respect to the profits that they generated over the latter part of 2022, but what their forecast is going into 2023. We'll begin with the banks on Friday, move into the tech companies after that, and then into the industrials and consumer stocks in the early parts of February. Those 3 weeks are going to be exceedingly important for our understanding of economic growth, consumer strength, and ultimately whether we can avoid that recession concern.
So taking a small step back just from the Friday data that we're getting today, let's now put this on the same page as the JOLTS data and other data that you and I have been talking about earlier on in this week. What is the now full first week of the new trading year's economic slate of data tell us?
It's mixed. It truly is. I think that GDP Now forecasting data from the Atlanta Fed is probably the most puzzling. It's real time, so it's not necessarily going to reflect the changes that we've experienced this morning. But it does indicate really significant and broad-based momentum for the economy over the fourth quarter of last year and heading into the start of this year. But because we're seeing contraction in the services sector over the month of December, which is incredibly important given its strength and breadth, we do have to now wonder what pace that momentum is going to be going into 2023, and we simply don't know that yet. The job market picture is too fragmented at the moment to give us a full understanding, and a lot of the metrics that we typically follow were disrupted so significantly as a result of the pandemic that we just can't trust the arithmetic right now. And that really does volatility is creeping up as well. So the professional investors that are paid to understand this are in some ways just as puzzled as we are, JP. And we probably won't get that clearer picture until we get deep into 2023. And by deep, I mean it may be into March or April before we really get the solid set of figures on inflation, growth, and corporate profitability that will give us a much clearer picture.
Puzzling is a good word to use as we describe, well, virtually all of this. Before we pivot and talk about Tesla more specifically, I would like to give you the opportunity to address anything else that's employment related, that's wages related, that is FOMC related, that maybe we did not talk about yet.
Well, there was one thing that I neglected to mention, actually, JD, and that was the inflation rates that we saw out of Europe this morning. They had a big pullback in their Europe-wide reading for the month of December. It had been at 10.2% over November, which was a record high. It decelerated to 9.2%. Still incredibly high, but a really big month-on-month change as a result of the drop in energy prices and the sort of very unseasonably warm weather that they're experiencing on the continent. Now, core inflation rates actually bumped up a little bit, which again sort of illustrates the complexity of the inflation picture writ large. But that headline deceleration, if it's replicated in the coming months and is echoed in any way here in the United States, is going to cement the case that many economists have put forward over the past few months, and that's that we are going to see that arithmetic slowdown in headline inflation on a month-on-month basis going into 2023. If that turns out to be true, that, along with all the other things we've been speaking about, corporate profitability, the Fed's reaction function, and what we are seeing from consumer spending, will be incredibly important and largely the focus of market into the first and second quarter.
All right, shifting our attention now to Tesla, that company yet again slashing EV prices in China. You and I have discussed many times about the importance of that market and some of the challenges that it, at least in this environment, puts on Tesla and Mr. Musk. What did we learn there?
Yeah, big price cuts in China. I think it's the third in about 4 months, if I'm not wrong. But the breadth of the price cuts was really quite significant. In some cases, as much as 13% for the Model 3 and Model Y models that are produced out of Shanghai. There were also price cuts in South Korea, Australia, and Japan as well. So that really is indicative of a dip in demand in the region, and maybe more importantly, concerns about logistical challenges coming from that Shanghai Gigafactory, which was closed in the latter part of December as a result of not only the COVID disruption, but demand concerns. We also heard late yesterday, JD, from the China Passenger Car Association that deliveries in China fell to the lowest level in 5 months over December, certainly linked to the Shanghai disruptions, but also the fact that the COVID situation there is just upending consumer spending models, and therefore an important market for Tesla is now suddenly at question. Not only the result of the COVID changes, but also the likely recession that the Chinese economy is experiencing right now. So once those things have been folded together, we saw a really big dip in Tesla stock pre-market. It hit a fresh 2-year low in early trading this morning. And with earnings coming up in a few weeks' time, people are really focused on profit margins based on these price cuts that we've been witnessing in Asia and elsewhere.
And to that point about the stock, it's currently trading at 106, and people who follow the stock for quite some time will say, yo, boy, 106. Yep. In fact, it's now trading down 2.99% on this trading Friday. As we speak, we will continue to follow it. So obviously here, Martin, I assume safe to say, pretty major concern for investors in this stock who are wondering, for the love of all things holy, where is the bottom to this thing?
It's going to be really hard to find that bottom, JD, because not only, I think whilst we focus on the actual price that we see on the screen and the percentage gain and the percentage decline, it's important to remember that professional investors are focused on the price to earnings ratio. In other words, how much are they paying for each dollar of earnings? And as a result, is the stock expensive or cheap on that relative basis? Now, when there is so much uncertainty with regards to potential earnings performance, that price to earnings ratio becomes more and more difficult to calculate, because the most important price to earnings ratio is based on forecast for earnings over the next 12 months. So when you get these big disruptions in key markets, China being one instance, and also here in the United States, where there's big questions as to whether some or all of the models will be applicable to the Inflation Reduction Act and the $7,500 tax credits, it becomes exceedingly difficult to understand earnings generation, and as a result, to calculate that PE ratio. Without having consensus on the PE ratio, or at least a moderate consensus, it becomes exceedingly difficult to discover whether the stock is cheap or expensive compared to its sector and compared to its peers. And that's really what we're seeing right now. And that is being further disrupted by the fact that there's a great deal of short interest out there in Tesla stock. And by that, I mean there are a great deal of investors who are betting against Tesla performance in the near term because of not only Mr. Musk's distractions with respect to Twitter, but the instances that we're seeing in China with price cuts and demand questions and everything else like that. All of this together is really creating this sort of morass that we're seeing around Tesla shares, the fresh 2-year low that we saw this morning. And the fact that, and I guess I didn't really appreciate this number until I did the arithmetic this morning, JD, the stock is off more than 40% over the last month alone. I wrote a story back in November where one of the major Wall Street banks said that the sell-off in Tesla shares was overdone and would come to an end within the coming days. Well, 30 days after that, it's fallen another 40%. This stock is in a bit of a maelstrom right now, and it's hard to know what's going to pull it out of it.
Yeah, oops, that's a little bit of cleanup on aisle 4. You know, we had a great conversation with Dan Ives of Wedbush, obviously, who is very well known as being one of the definitive go-to media voices for what is happening with the stock. And his argument obviously, if you talk Tesla, you have to talk Twitter. You know, it was basically Twitter needs a new leader as soon as the time period between now and Tesla's earnings. That's Dan Ives. That's what he has to say. He's like, I'm paraphrasing when I say that. He says Twitter needs a new leader as soon as yesterday, but that it's clearly indicative of a perceived distraction, Twitter is, to Tesla. Dan told me Elon Musk is Tesla, Tesla is Elon Musk, and I wonder how soon you see some necessary movement needed even on the Twitter side as we do get closer by the day to Tesla's first earnings report of the new year.
I have mixed feelings about that. I'm going to defer to Dan's expertise on pretty much all occasions, so I don't necessarily want to disagree with his thesis. But here's what I would say. The conditions that we are describing with respect to Tesla challenges are not going to be solved by Elon Musk. They're simply not. We're looking at demand fading in China as a result of the COVID crisis, logistical challenges at the Shanghai Gigafactory because of the same situations, and a pullback in consumer spending all around the region. He simply can't change those dynamics. He may be able to put in place different corporate practices, but he is not going to be a magician with respect to changing demand dynamics, and that's ultimately what this story is at the moment. On the Twitter side, I think it's worth noting that there is so much personal wealth of Mr. Musk himself at stake in the Twitter turnaround that he's probably just not prepared to hand over the reins to someone else just now, when that company is also facing headwinds of slower ad spending and concerns about its content moderation. So he's in a bit of a pickle. He is either going to have to rescue Twitter in order to ensure that his personal wealth doesn't erode any further, or he's going to have to hand over the reins and come back and guide Tesla into a market that he's going to have very little influence upon. And as a result, I think that's why you're seeing such bets against both companies at the moment, because despite his prior successes, it really does seem like a difficult task for anyone, Mr. Musk included, to guide both of those companies through these difficult near-term position. And I just don't see him waving a magic wand at this point in order to try and change the fate of either company.
All right, time now for our rapid fire section to get ahead here for a few other stories before we wrap up the broadcast on this Friday. Martin, up first, how did Costco impress with its December sales?
Yeah, that was a really big gain, actually, 7% increase compared to last year for December sales. They call it December, but it's effectively the 5 weeks that end on January 5th. And the number, I think, was about 23.8 billion. It's important for a couple of reasons. It's a nice rebound from that November decline that we saw for Costco. And as a result, the stock is up pretty solidly this morning. But it's also indicative of probably better retail spending than maybe we anticipated. Costco was the first of the major retailers to give us any indication on December spending. And because it was much better than anticipated, without the benefit of an increase in gas prices, we can potentially do some linear equation and suggest that spending might be a little bit more robust than we had hoped. So that's why Costco was important this morning. The stock is getting an outsized gain as a result of it, and we'll see how it filters through into the broader sector.
Not that you needlessly want to have an early jump to reaction for this next one, but is Vince McMahon's return a good thing for WWE? Keep it in mind, right behind me, Martin, as we speak, the stock is up 18.67%.
There we go.
Oh, Dave, your thoughts? I'm looking at it in real time.
I mean, that's 20 or 30 billion dollars worth of added market value in 24 hours, JD, as a result of the founder and former CEO Vince McMahon coming back into the fold. So it does indicate exactly what kind of control and influence he has on this company. And it's worth remembering, WWE has a $6.1 billion market value. It's a titanic company in the media and entertainment business, and an important one as well. So I think the fact that he has come back and he is a controlling shareholder is going to elicit the kind of gains that we're seeing this morning. He says that he wants to help with the negotiation of media rights. He is obviously incredibly influential in that regard. So I think investors are seeing this as a positive thing. But there is the overhang of the allegations that he faced over the summer when he left as CEO. And they were included, amongst other things, paying hush money payments to a former colleague as a result of a consensual affair. Now, it's interesting, JD, in looking at the story this morning, I did some research and I discovered that WWE itself had said around August that it found $15 million of unauthorized expenses linked to Vince McMahon, which we can only assume at least partially defend the reporting that says he had paid these hush money payments. We haven't connected A to B, but there certainly does seem to be some anecdotal evidence there. So the investigation continues to hang over his leadership, and his return as chairman probably puts him in effective control. Those two conditions might clash in the near term, but at least for the moment, investors like what they see, and they're lifting the stock pretty heavily.
Absolutely, at least for now, that is the case. Number 3, Samsung reported its weakest profits in 8 years, Martin. Where does it go from here?
Yeah, this is really interesting. And Samsung is just a company that we should probably all pay a lot more attention to. It's not only the key smartphone rival to Apple, but it's the biggest chip maker in the world. What they see in both of those markets is incredibly critical. Now, what Samsung typically does in the early part of the month after their quarterly earnings is give us just a very sort of back of the envelope projection as to what they see with respect to earnings. They're going to have about 3.37 million in net income, and I think it's about 55 billion in overall sales. They'll update us at the end of the month with a lot more detail and margins and everything else like that. But that projection would be the weakest that we've seen since 2014. I'm kind of surprised that it hasn't filtered into Apple's performance this morning, because I certainly thought that it would. But what it also does is reflect the conditions that chip makers here in the United States are going to face, not only in the coming quarter, but indeed through the whole of what's going to be a very difficult 2023. So again, I'm a little bit surprised that the market hasn't reacted to that, but maybe they're waiting for the details from Samsung later this month.
All right, fourth and final. This is the ultimate week in terms of big picture perspective. If you're a sports fan, if you're a fan of the National Football League, the way you and I very much both are,
Indeed.
The NFL is officially canceling what was the Monday night game between Cincinnati and Buffalo. But in terms of what's most important, which is to the left of the screen, the health of that 24-year-old, your thoughts here? Does it matter?
Yeah, I think from the NFL's perspective, it does and it does not. I think the optics of the decision to cancel the game are very good, because once again, they just reflect the human condition for the horrific injuries that we witnessed on that Monday night. From a practical perspective, it doesn't really change that much. The Bills, if they win this weekend, are likely to get the bye in the playoffs. It may be slightly unfair to the Ravens because they may end up in a coin toss for home field advantage for the playoffs. But this was there was no perfect solution to the result of the injuries that we saw and the disruption that it created. So I think the NFL did probably the best it could. But what we are understanding is that his condition is improving by the day. He's communicating with family members through writing and hand gestures. And as a result, his lungs seem to be improving. He's still in critical condition, but nonetheless, I think doctors appear to be a lot more optimistic than they were even 24 hours ago. And that is indeed great news, and certainly the most important component of the story. But I think the fact that the NFL has reacted this way is probably a good thing. Again, perhaps slightly unfair to the Ravens, but at the end of the day, I think it's the best solution that could come out of what was really a horrific incident on Monday evening.
And at the end of the day, it is called the game for a reason, because that's really all it is. And Martin, if you don't mind me asking you personally, I remember during the real era where the CTE recognition, the cognizance was really driven forward, and I personally grappled with it as a football fan. And I think back to earlier this week, Sunday was such a day of celebration as a Giants fan. I was out there, punched a ticket to the playoffs, felt on top of the world. And my love for the sport was so emboldened in ways it hadn't been in years. And that rightfully was so questioned just 30 hours later as we sat there and watched Monday night. And if you don't mind me asking you, I know you love your Miami Dolphins, and we talk about these things all the time. We also talk about the health and wellness of these athletes often. How do you find yourself now heading into the final regular season week? We got a lot of great playoff football ahead, but this is certainly something that is going to, I think, weigh on the hearts and minds of a lot of fans like you and me both for a while, right?
No, I think you're absolutely right about that, JD. I think to some degree, sports fans have been wrestling with that contradiction for a number of decades now. I mean, I grew up in an era where championship boxing was the highlight for any sports television calendar. And the best, the heavyweights commanded incredible television audiences around the world. And the principal aspect of that sport, of course, is to create concussion conditions in your opponent. And we celebrated that and continue to do so. We continue to do so with mixed martial arts and ultimate fighting and all of these other sports, which, again, the principal condition is to either put your opponent unconscious as a result of a chokehold, or knock him unconscious as a result of the blow to the head. And we seem to be able to get past that as well. Fighting in NHL hockey is something that we've been conditioned to experience in a positive way for a number of decades, even though that, of course, has had traumatic sort of results on the athletes that play it. In baseball, players really dole out their own in-game discipline by throwing a ball at a player's head at a speed of about 100 miles an hour. So I think while we do sort of question our love for this sport as a result of these traumatic injuries that we see from time to time, I think it's worth remembering that we have wrestled with paradoxes in sport for a number of years now. And for whatever reason, we seem to be able to get by them for the entertainment. And maybe that's something to give consideration to.
Absolutely. That's just an incredible perspective, Martin, and I always appreciate the context. And I hope you didn't, I had a feeling you wouldn't mind that last, a bit more personal question, and you really brought to the surface a lot of components about this, about how we've all grappled with this across many sports for a long time, and it's something we continue to do. And I think it's safe to say that this week of football coming up will be unlike any that we had, and this playoffs and the Super Bowl will be unlike any that we had, and we will certainly keep, keep our thoughts there with the Hamlin family as we continue, and we all will,
Yeah, no, you're absolutely right, JD. I think that's an important point to make. If nothing else, what we need to do is humanize the athletes that we watch participate in these contests on a day-to-day and a week-to-week basis. I think fantasy sports and betting and all the other things have reduced players to columns and spreadsheets and statistics, and I think that's absolutely wrong. I think it's important to remember that these are human beings, and in some cases very young human beings, that are putting themselves at risk in order to entertain us, obviously to make money at the same time and develop a career. But again, like you said, these are all games, and these men and women are playing games and putting their health at risk for our entertainment. If nothing else, if we can humanize that behavior in a way that makes us look at them in a way that is absent of their statistics, that would be a good outcome from this tragic event.
Martin Baccardax, thank you as always, my friend. Have a great weekend. We'll see you Monday.
Thanks, JD.
All right, that's going to do it for the Market Open. Stick with the Street for more on these and all of the major market stories that matter to you. Have a great weekend, and we will see you next week.